Welcome to the next video in our Know Your Numbers series. Today we're going to talk about figuring out your business's break-even point. So what is a break-even point? Well, the break-even point is the amount of sales that you need to be able to cover the costs of running your business. As you know, you have your top line, which is called sales or revenue. It's usually called one or the other, but basically it's all the sales that you take into your business. Well, in order to do and figure out a break even, we need to know what it's going to take to be able to cover all the expenses for you, as well as the cost to produce those sales and revenue. At the end of the day, there are no profits, but there's no losses either. So it's how do you get to that break even 0 point? So why is this important? Because it gives you the minimum amount that you need to produce in sales in order for you to be able to keep your business afloat. Now, seasonality is huge because for most of you, you do not necessarily do the same amount of sales month after month. That's a goal that we would love to be able to have, but the reality is it's not always that way. So it's helpful for you to know what your break-even point is month by month, because you need to be able to, now your total break even might be very similar, but you sometimes need to know how much money you need to set aside during those really busy months in order to be able to break even in the colder, slower months, whenever that may be. So even though a lot of it will stay the same, you still need to know what that is. And here's the thing, if you try to go Google your break-even point, you may have even tried to do this, it will blow your mind. There's so many different ways that people are trying to tell you, and they're trying to tell you these weird calculations that you would never even know in your business. Well, my mission here is to help make this a little bit easier. Now, it still might seem a little confusing the first time you watch the video, so it is one that I recommend that you look at a couple of different times, which we'll talk about later on, but it's going to be way easier than what you're going to find in some of those Google searches. So the first thing that you need to know is you need to know your expenses. These are the expenses that it takes for you to be able to keep your business going. You have two types of expenses. The first one are your fixed costs. Those are the costs that stay the same regardless of your sales. Your rent, if you have a brick and mortar, anything else that you rent out, your insurance, rental equipment, sometimes subscriptions, some forms of advertising is the same month to month. Your credit card bill sometimes stays something. So you want to look at that. Your variable costs are things that are more dependent upon your sales, so they tend to fluctuate a lot more. Payroll is probably the biggest one in this category because of the fact that you hire more people, you give them more hours during certain times of the year versus other times of the year. Your product costs obviously are going to vary. There's some things that are in that, employee expenses, stuff like that. Now, advertising, I mentioned that earlier. Advertising can actually fall into both buckets because if you have something that, say, you pay $50 a month for, that's going to be a fixed cost. But let's say you throw extra advertising out there during your peak time, in which case that would be a variable cost. So your advertising might be something that falls into both of those categories. Now, the next thing that you want to do is you want to add all of this up. So let's just say your fixed costs come to $500 a month, but your variable costs can run anywhere between $500 and $1,000 depending upon the time of the year. So when you figure this out, you're going to know that you're going to have anywhere between $1,000 and $1,500. We're looking for the average, what typically happens. So in our example today, we're going to use $1,000. The second thing that you're going to do is you're going to identify your average gross margin and your gross margin percentage. But in order to get there, we kind of have to understand a few different things. First off, your profit and loss statement, which is where you start with your sales. And as you know, you take off your cost of goods sold to come up with what your gross profit is. So if we know that our profit and loss is all based off of sales, everything on that profit or loss is also a percent to sales. So let's take a closer look at this. If we have an example, let's just say we do $88,000 in sales, and our cost of goods sold in order to produce those sales come to $48,000. We then know that our cost of goods sold percentage is going to be 54.54%. We take our cost of goods sold divided by sales. Everything on the P&L is divided by sales to get that percentage. So we know that 54% basically of every dollar we take in is going to go to producing it for those costs of goods sold. So in order for us to identify our gross margin, we look at the other part. We go to our gross profit first. So we know the $88,000 minus the cost of goods sold. So minus the $48,000 is going to give us $40,000. $40,000 is our gross profit. So in order to figure out that percentage, our gross margin, we are then going to take our gross profit of $40,000 and we're going to divide it also by our sales of $88,000. In which case we now get 45.45%. So if you notice, if you take your gross margin plus your cost of goods sold, we know that comes up with our total sales. So our percentages should also equal 100%, which you're going to notice the 54.54 in cost of goods plus our gross margin of 45.45 equal 100%. So we know that we are on target. Now, let's go back to our example. We know that our monthly expenses are $1,000 a month. And we now know that our gross margin percentage is 45.45%. So how do we take those two numbers to come up with how much it is that we need to do a month in order to cover our $1,000 a month of expenses? To hit our break even of $1,000, what do we need to do in sales? Well, let's break this down even more. So we take our $1,000 a month and our gross margin and we do the following. We also know that our sales minus our cost of goods sold minus our expenses is what produces our profit. So in our break-even scenario, we want to take our sales minus our cost of goods sold. We don't know what those numbers are yet, so we can't fill those in yet, but we do know that our expenses are $1,000, and we also know that we're trying to get to a break-even, so we know that our profit is going to be zero. Now, believe it or not, when you thought you didn't need to know that math and that algebra and all that, yes, you do. You use it all the time. You just don't realize it. So basically, here's what we're going to do. We're going to take our sales minus our cost of goods sold because we know we need to come up with that $1,000. We take the 1,000 from one side and move it to the other side. So now we know sales minus cost of goods sold needs to equal $1,000. So here's the calculation that you're going to use in order to figure out your break even. You're going to take your $1,000 of expenses that you need to break even, that's what we know we need to come up with, and divide it by our gross margin percentage of the 45.45%. So you'll see on the bottom, 1,000 divided by that 45.45% is going to tell us that we need to do $2,200 in sales to break even. Now let's do the math backwards. I'm a huge fan to make sure that we came up with the right number, because right now you're like, Tammy, how on earth did you even figure that out? Well, let's look at it from a different angle here. So let's check the math. We know our sales, we just figured out we needed to have for our break even was $2,200. And we know that from those sales, we're going to have our cost of goods sold and we're going to have our gross profit to equal our zero, right? So let's look at it. Our cost of goods sold at the 54.54% that we calculated earlier means 2,200 times the 54.54% equals $1,200. It's a little bit shy of that, but it's that number. Our gross profit is going to be 2,200 times 45.45, and that equals $1,000. Putting it into our calculation, because of sales minus cost of goods minus expenses equals profit. Let's see what happens. $2,200 in sales minus our cost of goods sold of $1,200 minus our $1,000 of expenses. We should get zero for our break even, which is exactly the number that we wanted to get. Now, obviously, these numbers are using our fictional business. You're going to want to go back through this entire video, but plug in your numbers in order for you to be able to figure out what it is that you need to do for your business to be able to get to your break even. And don't forget that you want to do that for every single month. So this way you can plan ahead and use the money from your best months to help you out through your slower months. And by the way, if you want to learn even more, we're putting together a course called KnowYourNumbersCourse.com. And if you go on over there, we're going to be putting together not only more of these videos to help you understand your numbers, but expand them even more with some worksheets and some spreadsheets and some different things to be able to help you grow your business and grow your business knowledge, because knowledge is power. So if you want to take a deeper dive into learning and understanding your numbers to start earning more profit, head on over to knowyournumberscourse.com and take a look at what we have over there. All right. And by the way, hit the subscribe button here that is with YouTube, so that way you can get all these videos that are going to be coming out. We're going to try to continue to add them to be able to help you with your numbers. And don't forget to listen to the Local Small Business Coach podcast, where every week we talk about different tips for you and nuggets to help you grow your business, not only in your numbers, but in everything else as well. And by the way, don't forget, be the badass that I know that you are. Thanks for watching.